If you just saw how much you owed in taxes for 2025, you're going to want to hear this because there are now legal 100% tax write-offs available in 2026, and most business owners have no idea they're back. And meanwhile, the ultra wealthy are already structuring purchases around them. I'm Henok Kebede. I'm a licensed certified public accountant and founder and CEO of HK Financial Advisory. We help high-income business owners legally reduce their tax liability every single year using strategic planning at yourtaxsavingsblueprint.com. And today, I'm going to walk you through 5 powerful 100% write-offs you need to understand for 2026. So these apply to vehicles, equipment, real estate, manufacturing facilities, and research and development. Now, regardless of which political party passed what, the law is the law. And if you own a business, these provisions can highly benefit you. So let's break them down. All right, write-off number 1. Imagine buying a business vehicle and deducting 100% off the cost in the same year. See, under the restored 100% bonus depreciation rules for property placed in service after January 19 of 2025, this also applies to 2026. But here's what that actually means. So let's say you bought a car for $85,000, an SUV for your business. If it qualifies and it's more than 50% used for business, that could potentially be an $85,000 deduction in that year. Now, if you're in the 35% tax bracket, combined federal and state, that's nearly $30,000 in tax savings. That's not a rebate. That's not a credit. That's an actual reduction of your taxable income. But here's where people mess up. All right. So the first rule is business use must exceed 50%. The second one is documentation. That's really important. And the third one is if the vehicle weighs under 6,000 pounds gross vehicle weight rating, it may fall under a luxury auto cap under section 280F. Those caps limit first-year deductions, but the vehicles over 6,000 pounds often avoid those specific caps. That's why you see so many business owners purchasing heavy SUVs and trucks. But don't misunderstand this. You don't buy a car to save taxes. You buy a vehicle your business genuinely needs. And that structure is the correct way. Because if you buy it without a plan, you might get the wrong deduction. And if business use drops below 50% in future years, some of that depreciation can be recaptured. And that's where strategy separates amateurs from professionals. Next, write-off number 2. So let's talk about equipment and machinery. This one is massive for operators, contractors, dentists, restaurant owners, content creators, medical practices, landscapers, etc. Under the 2026 rules, tangible business property with a useful life of 20 years or less may qualify for 100% bonus depreciation. So this includes your computers, machinery, office furniture, tools, software, and then specialized medical or industry equipment. Now let me make this practical. Let's say you're a dentist upgrading your practice. You invest $200,000 in new imaging equipment, chairs, and technology. Under prior rules, that might have been deducted over 5 to 7 years. Now, it could potentially be deducted immediately. Again, if you're in the 35% federal tax bracket, that's $200,000 deduction could reduce your tax bill by roughly $70,000. That's not small. But here's what matters. The equipment must be placed in service, meaning it's installed and operational, not just ordered, not sitting in some warehouse, not arriving next year. And this is where business owners miss the timing. They assume signing the contract is enough. It is not. Placed in service before December 31st is what counts. Now here's the strategic shift. You don't buy equipment to save taxes again. You buy equipment that increases productivity, revenue, and efficiency. Then you align the purchase with tax strategy. See, if the purchase increases revenue and reduces your taxes, that's leverage. But if it doesn't increase income, it's just spending. And bonus depreciation doesn't turn a bad investment into a good one. Strategy matters. All right, so write-off number 3. Now, this is where things get serious. See, real estate is one of the most powerful wealth building tools in America. But most investors do not understand how aggressive the tax side can be when structured correctly. When you purchase a rental or a commercial property, the IRS doesn't treat the entire building the same. The structure itself might depreciate over 27.5 years for residential or 39 years for commercial. But many components inside that property are actually shorter life property, like 5-year, 7-year, and 15-year. Examples include appliance, your flooring, your cabinetry, lighting systems, plumbing, landscaping, parking lots, fencing, and drainage systems. Now here's where bonus depreciation changes everything. Under the restored 100% bonus rules in 2026, those shorter life components can potentially be deducted immediately. So let's use a real world example. Say you purchase $1 million rental property and you do a cost segregation study which identifies $350,000 of components that qualify as the 5, 7, and the 15-year property. If eligible, that $350,000 can be deducted in that year in year one alone. And let's say if you're in the 35% bracket, that's over $120,000 in potential federal tax reduction. Now let me clarify something important. This does not mean you make $120,000. It just means your taxable income is reduced by that $120,000. That reduction obviously depends on your income level. But here's where strategy separates professionals from amateurs. Passive loss rules still apply. If you are not materially participating or you don't qualify as a real estate professional, those losses may be suspended. They don't disappear, but they may carry forward. This means you could generate a large deduction and not use it immediately. That's why planning around income, grouping elections, and participation status really matters. Some of our higher income clients pair cost segregation with income spikes intentionally because deductions are most powerful when they offset high income years. And here's something else. Cost segregation does not increase your total depreciation over time. It just accelerates it, brings it forward, which means you must understand future recapture rules when selling. So if you're flipping properties in 2 years, your strategy looks completely different than someone holding assets for 15 years. Real estate tax strategy is not just about buying property. It's about timing income, structuring ownership, and planning your exit. That's where real leverage happens. Next, write-off number 4. And this one is least understood, but a very powerful provision. It applies to production and manufacturing facilities. And this one is not widely talked about yet, but for the right business, this can be massive. Recent tax law updates allow certain qualifying production facilities to potentially be expensed immediately instead of depreciated over decades. So we're talking about the building itself, not just equipment inside of it. Now, historically, commercial buildings were depreciated over 39 years, just like how we mentioned earlier in the real estate section, which meant even if you built a $2 million facility, you might only deduct about $50,000 per year. But under the updated expensing rules, certain facilities used primarily for manufacturing or production activities may qualify for accelerated or immediate deductions. And this is where definition matters. Production generally means creating or substantially transforming a product. This could include manufacturing, fabrication, assembly, food processing, industrial production, and certain technical production environments. But there are important requirements. See, the property typically must be used primarily for production, be owner-occupied, and not be leased to another business. It has to be used in active trade or business. So this does not apply to office buildings, retail centers, or passive real estate investments. This is for operating businesses producing goods. Now let's put numbers to this. Let's say a company builds a $3 million facility that qualifies. If structured properly and eligible, that could create a deduction in the millions in year one, which could translate into hundreds of thousands of dollars in tax reduction, depending on income level. That's why large operators pay attention to these rules early, before construction even begins, because timing really matters. Your entity structure really matters. Ownership structure matters, and qualification must be evaluated before the project starts, not after. This is one of those strategies where planning ahead can change the entire financial outcome of the project. Now let's talk about write-off number 5, which is research and development. And this is one of the most misunderstood areas in the business tax space as well. For years, domestic R&D or research and development expense had to be amortized over 5 years. That created serious cash flow pressure for startups and companies that are scaling. Recent changes restored that immediate expensing for qualifying domestic research and development. But here's what people miss. R&D is not just like lab coats and scientists. It includes developing new software, improving your internal systems, designing new products, engineering prototypes, testing new processes, and technical experimentation. If your business is solving technical uncertainty, you may qualify. So let's use numbers. Let's say a technology company spends $400,000 on domestic software development and engineering payroll tied to the qualified activities. Under the restored expensing rules, that $400,000 could potentially be deducted immediately. And if you're in the 32% tax bracket, that's roughly $128,000 in tax reduction. But it doesn't stop there. On top of the deduction, you may also qualify for R&D tax credit, which is a dollar-for-dollar reduction of tax liability, not just a reduction of income. In certain cases, companies may deduct the expense and also receive a credit based on incremental qualified spending. But here's the part you don't hear about on social media. Documentation is everything, guys. You need project descriptions, technical objectives, experimentation records, payroll allocation support. See, the IRS looks for proof of technical uncertainty and systematic experimentation. This is not something you estimate after the fact. It must be substantiated. And here's the strategic angle. R&D expensing is powerful when layered with other strategies like equipment purchases, entity structure planning, income shifting, equity compensation planning. This is how scaling companies reduce tax liability while reinvesting in growth. The goal is not just to deduct spending, it's to compound growth tax efficiently. That's a different mindset. Let me pause for a second, because this is where most business owners miss the bigger picture. The wealthy don't buy assets randomly. They attach tax strategy to purchases. They don't ask, how do I pay less tax? They ask, how do I structure this correctly before I buy? That's a completely different mindset. Taxes are not reduced in April. They're reduced before December 31st. If you're making decisions in March when your CPA tells you what you owe, you're reacting. And reaction is expensive. Planning is very powerful. And here's the truth most people don't like hearing. You don't reduce taxes by working harder. You reduce taxes by structuring smarter, by aligning income, asset purchases, entity structure, your timing, participation, your exit strategy. When those pieces work together, that's when tax liability drops significantly. Not because of a loophole, but because of design. That's the difference between filing a tax return and building a tax strategy. If you've ever written a big check to the IRS and thought, there has to be a better way, this is the better way when structured correctly. So here's the real question. If you're already planning to invest in your business this year, why wouldn't you structure it correctly? Because the difference between a purchase and a strategy can be tens of thousands of dollars, especially if you're generating strong income, especially if you're expanding, especially if you're scaling. That's when these rules matter most. So to recap, vehicles, equipment, real estate, production facilities, research and development, all potentially eligible for 100% expensing in 2026 if structured properly. And that's the key, if structured properly. If you're generating strong income, expanding your business, or planning major purchases this year, this is not something you want to guess on. If you want proactive tax planning, not reactive tax filing, go to yourtaxsavingsblueprint.com. That's yourtaxsavingsblueprint.com. There, you'll see exactly how we approach tax strategy for business owners, and you can apply to work with us if it makes sense for your situation. Because tax savings aren't accidental, they are engineered. And if this helped you think differently about your 2026 tax strategy, make sure you like this video and are subscribed to this channel, because we break down advanced tax planning strategies like this all year in plain English, so you can make smarter decisions before December 31st. And if you know anyone, business owners, an investor, or someone who just wrote a painful check to the IRS, share this with them. Because most people don't need more income, they need better structure. And the sooner you understand how this works, the more control you have over your financial future. Thanks for watching. I'll see you on the next video.